Okay, all right, real estate investors. It is the middle of the month, so it is time for Mike's market update. Took March off while we were in Hawaii, but obviously got a lot of data to cover. It's been in a crazy market, so let's just jump right into it. So last month, um, I talked about interest rates, and I talked about interest rates potentially going up, and then literally the day after recording, and it wasn't last month, it was in March, and then the day after recording in March, interest rates started going up. So we're going to talk about interest rates, inflation. Inflation conversation grew extensively over March. It's been a discussion since last March, but with interest rates rising, bond yields rising, it became a big focus of last month, and then CPI numbers came out last week as well. So we'll get into that, and then we'll really talk about the Fed activity and their policy framework. Got some good slides on that, and we'll talk about why we're not going to see the Fed take any action, even though CPI is showing inflation, the talk is around inflation, bond yields are going up because of a concern about inflation. So we'll get into all that stuff. And on the micro Portland level, why is it so competitive? So the market, it's ridiculously competitive right now. Supply levels are the lowest they've ever been. We're going to go blast to the past. We'll look at supply levels in the past to kind of give you some context and some reference to where we're at now, and then we'll look into the affordability numbers. So let's get into it on the macro level. Inflation, inflation, inflation. So inflation has been picking up. It's starting to show itself in the consumer price, but let's really look into the numbers and see what the problem is. So sentiment rises along with inflation expectations. That's really been the theme since mid-February. So mid-February is when I did the last recording. Literally bond yields started to spike right after that presentation in mid-February. Mortgage rates started increasing, bond yields started increasing, and then just talks about inflation started increasing as well. So consumer price index came out last week, 2.6% 12 months. So looking back from March of 2021 to March 2020. But what's the problem in that? And this is a baseline issue that a lot of people haven't really been talking about. Bloomberg wrote a really, really good article on it. But when you look at that 2.6%, you're comparing two problematic dates in time. And here's the problem. In March, the economy fell off the cliff. GDP fell off the cliff. And so we are in a very deflationary period, as you can see that. So here's COVID and here's that deflationary period. So when you compare March of 21 to March of 2020, you have this huge deflationary drop in those numbers. So for the month of April, May, and June, you can see in June we started to pick back up. We're going to have this baseline problem. So expect your 12-month, your year-over-year numbers for the next 3 months to look artificially inflated, artificially high. So when you look at consumer price index, inflation from early 20 to early 2021 hasn't really gone up, at least not significantly, at least not the way that the Fed measures it. We've seen inflation in assets, in crypto, in gold, in the stock market, in real estate. I'm not denying inflation is there. I'm saying how it's measured by the Fed from a consumer price standpoint, the numbers that we're getting are not actually accurate to what we're seeing. This is one reason the Fed is not going to act. The Fed has now changed their framework policy that we'll get into, or their policy framework that we'll get into, but we're not going to see any action from the Fed. Now, bonds have been a different discussion, and the conversation is bonds are trading at lower values because of inflation. That's making yields go up. And so there's concern in that bond market. But then there's actually some deeper stuff going on in the bond market that we'll look at as well. So why have we not seen inflation? So survival and stimulus capital. So early on, all that new credit programs, the PPP loans, the stimulus checks, all that money being created was just plugging a gap. So immediately when our economy fell off the cliff, we had a huge reduction in spending and a huge reduction in borrowing. And today we're still having a big reduction in borrowing. So stocks for the banks, the big three banks reported last week, and their demand for loans, demand for credit is actually down. So we're just plugging a gap. We haven't overfilled that gap, right? So if we have a reduction in spending and credit, we can fill that gap. We have to overfill that gap in order to actually see something happening from an inflation standpoint. So that's what we're not seeing. Also, Fed doesn't just print new money. This is something that I'm learning right now, reserve-based monetary creation that was started in 2008. Got some good slides on that. We won't get deep into this. It's something that I'm learning and I want to bring to the table, but we're not actually seeing, no one actually knows how much money has been printed or was printed through 2008. So we'll get into that a little bit. And CPI does not measure assets, right? The Fed lends, not spends. They're looking at the consumer price index. They're not actually lending money, putting it to the markets. Excuse me, they're not spending money and giving that money to consumers to increase consumer spending. That's what the Treasury does. The Treasury does the stimulus checks. The Fed lends. So the Fed gives money to investors who then invest that money in assets, which is why we see real estate, stock, gold, crypto, those assets going up because of the way the Fed goes. So when the Treasury gives money to citizens, that can increase consumer spending if they have the ability to spend it, if they have the ability to go out to restaurants, if they have the ability to travel. What most Americans are actually doing is they're reducing their borrowing now. They're paying down their debt, and we're showing that in the stock market for banks right now. So there's some quick thoughts on inflation there. So let's talk reserves-based monetary creation. So this is something that came out in 2008. You can see our 2008 recession. You can see the U.S. Treasury securities held by the Federal Reserve, all reserves is all maturities, meaning 2, 10, 15, and 30-year maturities. You can see they had a ceiling, an $800 billion ceiling. Then they reduced it. They started to reduce how many treasuries they had. Then 2008 happened, and then they increased. So what happened here when we went from essentially 500 billion in treasuries to 2.4 trillion by 2014? So in 2008, they created reserves-based monetary creation. So this is just moving around at the balance sheet. Essentially, they can take their US Treasury, turn those into reserves, or call them reserves, and then now lend based on that. In 2008, what they did create is they required depository institutions to have excess reserves, right? So this is some of the banking regulation that came out of the Great Recession. This was just prior to Dodd-Frank, where they changed banking regulation even more. So there was no excess reserves prior to 2008. So that's why you see that zero there. But this is what's uncanny. So once they create this law, this requirement for banks to have excess reserves, meaning the banks have to hold government debt, then what happens? It skyrockets. So is that the last slide? So we have 2.4 trillion that's held by the Fed and just over 2.4 trillion that was created. So just moving around the balance sheet is one way to add liquidity to the markets. And this is a tool that came out in 2008. I'll study it more. We'll talk about it more. But this is pretty crazy to see, again, how when we talk about how will we pay down this debt, who holds our debt is very, very, very important. And so that's why we're creating these reserves. We're forcing banks to hold government debt, allowing or excess reserves allows the Fed to buy more of our government debt. So it's really interesting what's happening from that standpoint. Now let's talk Federal Reserve policy, right? So 1977, 1978 is when they got their mandates, which is inflation control and then also unemployment rates. So when you hear the Fed, what are they looking at? They're looking at inflation and full employment. That is their goal. They don't want prices to get out of control, and they want to get full employment. That is the mandate of the Fed going back to 1977 and 1978. What's changed? So the new policy framework. So it used to be a very preemptive policy, right? So they had to target inflation of 2% and full employment. That's what they're trying to do. So if the market's getting too hot, if it's overinflating, then they raise interest rates before it overinflates. If the market's too cool, then they keep interest rates really low to try and force that inflation up. But they're very preemptive to what they do, right? And then the stock market is always looking for, well, what is the Fed going to do? What are their words? What are they saying? Let's get ahead of the curve. Well, in 2019, the Fed went back and studied years and years of their policy to come up with a new policy they took on in 2020. So last year, they announced this new policy framework. So instead of being preemptive and looking for a target inflation rate and manipulating interest rates and manipulating the amount of financial assets that they purchase, financial securities that they purchase to then create that atmosphere, what they're doing now is they're waiting for inflation to happen. Then they want it to be sustainable, and then they will start taking action. So they've gone from a preemptive policy to a reactive policy, and now they want average inflation of 2% over a period of time. So if you look at inflation during the Great Recession, it was very, very minimal, well under 2%. And so if you have a long sustained period of time inflation at under 2%, but we want sustainable 2% inflation over a long period of time, now you have to let it run hot for a period of years afterwards. And so that's exactly where the Fed is at right now. So they'll allow inflation to run over 2% in future times to make up for the times when it's less than 2%. So instead of proactively using tools, now they're going to be reactive, which this is a very good thing for the market, in my opinion, because it allows us to actually look at what's happening. So instead of guessing what the Fed believes is happening and then guessing what type of movements they're going to make, the Fed's flat out coming and telling you, this is what we want to see. Once it's been sustainable, then we will change our comments. So if you look back at all the Fed comments last week, they're talking about not changing interest rates to 2024 now. They're talking about 2022 possibly being a market where now they can start tapering, meaning the market is hot enough, inflation's high enough, they can slow down their asset purchasing. But we're not going to see any changes in 2021, probably won't see any changes in 2022, and maybe in 2023 we start seeing some changes after we've had inflation above 2%. So we're not even trying to get to 2%, right? 2.6 was the April rate based on looking at a deflated April of 2020. That's not even real. We have to get to 2%, then we have to be sustainable at 2% and go over 2% before they're going to start changing their policy. And here's their comments from Jerome Powell last week, which is exactly spot on. Markets focus too much on what we call the economic predictions, right? That was the past, the preemptive, the way the Fed views economic conditions. So this is the stock market trying to assume how the Fed views economic conditions, and then what does that mean, the changes that they will make, and trying to get ahead of the curve. Now, I would focus more on the outcomes that we've described. What are the outcomes they've described? Full employment and sustainable 2% interest in the inflation world. Excuse me, 2% inflation, not interest. So that is very easy for us to understand what's going to happen. As a real estate investor, this makes me very comfortable moving forward, because I know that the Fed, even though vaccine rollout isn't happening, from an Oregon standpoint, we're shutting our economy down again. The Fed is going to be very accommodative, helping us get through this policy. So let's talk about debt. Let's talk about debt and who purchased debt in 2020. So this is as of June 2020 of who owns what. So you can see the Federal Reserve is the biggest. Mutual funds are large. Foreign investors are big, but not significantly bigger than other. Let's talk about how that changed. So from that same period of time, end of June 19 to 2020, the Federal Reserve increased their holdings by 100%. Mutual funds by 83%. Now, it's common for mutual funds to own a little bit of treasuries, but this is a pandemic, a economy collapse decision for mutual funds to move into treasuries. So treasuries are seen as the low risk investment. It's the lower yield. Mutual funds want to create larger yields. But in times of concern, they're going to move into treasuries, which is A, considered safe. B, there will be yield, but it's a low yield. C, it's an equity play. It's a capital gains play. So as they go into treasuries and buy the bonds and treasuries, they can then resell those for capital gains. So if they're trading into bonds and treasuries early on, say yields are at 1.5%, they drop to 1%, and if yields go down to 0.5%, if they go in between 1 and 1.5% and they sell at 0.5%, they're actually creating a capital gain. So we're seeing money. This is kind of hot money. So Daniel Ammerman calls this hot money moving into the market, meaning they're not treasury investors. The Federal Reserve, they own a lot of treasury debt. That's the reason that they do it, is to keep facilitating liquidity to the market. But mutual fund investors, they don't normally do that. So this is considered hot money, which is really interesting. We're going to look at bond yields as well. So this is sources of funding. So you look at the Federal Reserve went from about 2 trillion to 4 trillion in 2020. 80%, somewhere around 2 trillion to 3.6 trillion in bonds. So their pieces of the pie got much, much larger. One thing that didn't really change is foreign investors. So now foreign investors still own a significant portion. They're the biggest holder of our debt, but the Federal Reserve is coming up behind. And this is actually a good thing. We won't get into financial repression today, but when we eventually have to deflate our deleverage our big debt that we're creating, having it held by our own Federal Reserve is actually a good thing. We'll talk about that more, but let's look at yields. So this is bond yields over a 5-year period of time. So as of today is 1.58%. So here's what happened early on in Corona, right? So essentially the world's going crazy. So big institutional investors are now buying the 10-year treasury. So yields go down, right? So the demand increases. There's only a certain amount of supply of these notes. So demand comes in, value goes up, yields go down. So you can see a sharp decline in yields, then they kind of stay on the market. They kind of stay towards the bottom. And then in February, I mentioned interest rates are not going to stay as low as they are. So interest rates track with the 10-year treasury. And so we talked about mortgage rates going up early February, and then boom, they went up. And so what happened is this. So this big demand or sellers, right? So we had a flip-flop of the market. So early on in the market, you think about, so the Federal Reserve is buying a bunch of treasuries, bond buyers are moving into the treasury market, removing demand, getting small yields, a safe investment, and now they're selling. So now that flip-flop. So we went from a demand-heavy treasury market to now a supply-heavy treasury market. And so that's what happens. Then those bond yields, the 10-year treasury yields, start to then increase significantly. It seems like they kind of leveled off in the past few weeks, but that's why you saw interest rates spike, right? So from late February, mid-February to mid-March, interest rates went from about 2.7% up to like 3.3%, and now they're settling around 3%. So that's exactly what we saw there. And so we talked about hot money, bond money moving into the market and then exiting the market, right? So really concerned about the economy, we're a deflationary market, let's get safe, let's invest in a 10-year note. Oh, the market's looking really good. Inflation concerns. Now we don't want those 10-year notes. Let's sell those 10-year notes, create a capital gains event, and then go buy different types of assets. So that's what we saw in this market here, is just a really adverse market, a quick drop, a quick change from a demand-heavy market to a supply-heavy market. And then we saw that change in the yield aspect there. And then mortgage rates. So here's exactly what happened, right? So February, mortgage rates started going up, right? So as bond yields started going up, so as sellers come into the market, selling more 10-year treasuries, meaning the yield goes up, right? So the value goes down, the yield goes up, you get that same happening here in interest rates. So 30 years is going to track closest to it. Your 15 years is the more volatile, and then the 5/1 ARM has less exposure, so it's the least volatile. But you can see interest rates started going back up and then back down. We'll talk about how that affects affordability when we get into the micro local numbers as well. Mortgage credit availability went back up for the month of March. Again, I really track the mortgage credit availability as a real estate investor selling real estate. I want to make sure that the mortgage market is functioning, which it is doing very, very well. So let's get into the Portland numbers. So this is the big numbers, supply levels, right? So we hit a record 1.1 months of supply back in September, matched it, beat it. And then so we've got 1, 2, 3, 4, 5, 6, 7 months of ridiculously low supply levels. So tons and tons of competition. We'll talk about this. I do want to get into some previous months as well, some previous years as well later on, and just to contrast where we're at. But competition is ridiculously tight. And when competition is that tight, this is what we can see. So if you look at a March 2021 compared to a March 20, then we get a 20% increase in the average sales price, a 15% increase in the median sales price, right? So that level of competition with really, really low interest rates, so a high effective purchasing power, that is what puts upward pressure on the market. That's what we're seeing. Great time to be a seller, yada, yada, yada. We've been talking about that forever. So inventory. So let's look at inventory. So here's where we started off, right? So we're off the normal chart. So if you look at the past 5 years of inventory, we're just off of the chart. You can see it started happening in the summer of last year, right? So Corona happened, didn't really affect our inventory in March or April, but then really started to affect it, a big drop from April to May, and just continued to drop and drop and drop until it's leveled out at around 2,000 listings now, but significantly low. It's a really low amount. So let's take a look at supply, historic levels of supply. So we're kind of back on track. So ever since about July of last year, outside of September, and then these numbers kind of, right? So that's the smoky, that was our fire season last year. These numbers kind of average out for September and October. Our new listings are kind of on track. So what's happened is this big drop in supply in April, May, and June. We just have never recovered from that, right? So from a seller standpoint, our listings, we're getting the typical amount of sellers coming to the market month after month after month since about July of last year. Demand, now we're kind of at the top end of the curve, the blue here, but we're back into contract here. So as our supply, our inventory was falling, we had excess demand late summer, fall, and into the winter. We're a little bit high now, but what I think we're seeing right now is that demand hasn't pulled back. It's just that supply levels are so low, we can't contract. We can't have these blue dots up higher. They would be if there were more sellers to the market. We just don't have those number of sellers to the market. Same thing on pending, right? So June, July, last summer, fall, winter, on the pending sales side, we just had atypical demand. It's all over the place. The pending sales are like that. They're more volatile than closed sales. But demand is obviously strong, even with increased interest rates. So here's that increase in interest rates, February to March, that did not pull back, right? And when you think about it, if we're getting 10, 15, 20, 30, 40 offers, and interest rates increase, and that pulls some of the buyers back. Well, okay, so you go from 10 offers to 5 offers, or 20 offers to 10, or 40 to 20. So it is reducing effective purchasing power to an extent, but not enough to really pull that demand back from the market. So we're still seeing that upward purchasing pricing. So again, let's get back into supply levels, and then let's look at some history for some context. So here's December of 2006. This was a hot market, 04, 05, 06, but look how high the supply level. So you can see how in 2004, it just got hotter and hotter and hotter. Supply levels lowered, creating more competition amongst buyers into 2005, where we got down below 2 months and kind of sustained that for the summer of 2005, and then 2006, and then we started growing again. Let's look at December 2009. So 2007, 2008, 2009. So in 2006, 2007, we kind of flattened out, but you can see us increase. And then in 2008, obviously, the stock market crashed in March 2009. The mortgage market started to crash in August. Mid to late 2008 is when we saw the mortgage market acting really, really weird. And then we saw the crash. So look how high those supply levels are. So when we talk about 2008 versus 2021, we're nowhere near this, right? We don't have a level of distress coming into the market. We have 500 million just at the state of Oregon level, $500 million of rent assistance coming from the federal government to the state of Oregon just for rent assistance. We're talking the last 1.9 million stimulus, $1.9 trillion stimulus package has $2 billion going to the state of Oregon, $500 million going to the city of Portland. So we're not going to repeat this. Supply levels are not going to shoot back up. So we're not going to have a market that A, is full of distressed real estate, and B, oversupplied. If anything, we're going to stay undersupplied because interest rates are still low, demand is still high. The Fed continues to buy mortgage-backed securities, adding liquidity to the market. Mortgage credit rating availability is going up. And then when we talk about mortgage assistance, foreclosure moratoriums, eviction moratoriums, there is federal money that is going to help that backlog. And what happened last year is the Consumer Bureau of Finance, Consumer Finance Bureau, gave an alert to mortgage servicers saying that if you don't work with sellers that are distressed, helping them come out of forbearance, we will keep an eye on you. So there's a government watchdog making sure that servicers work with distressed buyers to help them come out of this. So we're nowhere near that 2008 level. Let's look at affordability real quick. Here where we were in December, significantly affordable. We want to stay above the 100% mark. You can see in 2018, we got below that. And again, in 2006, we got below that as well. I haven't been around it since. So these are the December numbers, 130%. Remember, above 100 is affordable. In January, so what happened was interest rates went up a little bit. Median sales price increased from 455 to 460. So median sales price increased a little bit. Income stays the same. Interest rates go up a little bit. So affordability drops a little bit. Here we are in April. So income's the same. We have new income numbers coming out in April at the HUD level. So we don't know what income for 2020 is yet. I did read an article from Noah Bland in WFG. He said income did go up. And this is a different index that he was reading. I couldn't find the source. But remember, unemployment rate does not affect income. It affects unemployment. But those who have jobs, that's a different unemployment isn't affecting income. So it's possible that our income numbers go up as well, depending on how HUD looks at those numbers. Interest rates went up, right? So we went up at 2.7 in January to 3.18. Median sales price went up as well. So affordability declines quite a bit. So this is the interest rate as of April 1st. Interest rates have actually ticked down a little bit since. So down at 3.04, all their numbers the same, actually creates it more affordable. So we're still in an affordable market. So when you look at competition, really strict, not enough sellers, too many buyers, but the key is buyers that are in their affordable zone, meaning they can make their monthly payment in this scenario. Interest rates at 3%, 488. Well, let's offer 500 grand because we still are trying to target a payment around 25% of their gross income. They can make this payment go up and still be under 25% or above 100%. So that is what puts upward pressure on the pricing. Here's some projections I did back in January. So 3% interest with a 10% increase in the median sales price. For reference, in March, the median sales price was 48, if I remember correctly. So this is still higher than that. There's still room to run with 3% interest rates, which is kind of where we're at. So when I did this in January, I actually had people, why would you think interest rates are going to be at 3%? Because they were at 2.7 at the time. Because I look and understand the market. I understand bond yields were depressed. They've got to go back up. Interest rates have to go back up. They're not going to stay at that ridiculously low level for a long time. But it's quite possible that we end the year no higher than 3.25%, which again is a ridiculously historic low mortgage rate, which then puts upward pressure on pricing. But the market can still handle it. So when we look at monthly payments, house buyers do not buy based on value. House buyers purchase based on monthly payment. And when they have room to run in the monthly payment, that means they have room to run in the median sales price. And so I also try to solve for 100% back in January. So 100% affordability at 3% interest, which is kind of where we're at now. We can go up to 568. So at the time, that was 25% before we got into the 2008 territory, right? So getting down to 100% or up to 25% on their monthly payment. So we still have room to run. That's the sad thing. Well, not sad, but when you look at this exacerbated market that we're in, deep sellers market, still affordable for buyers, but are extremely competitive. That is why we're in this environment of ridiculously high increases in value. We haven't seen increases in value like this since 2014, 2015, 2016. And we have no end in sight from a release, right? So we don't have new sellers coming to the market. We don't have a rescue of more inventory. At least you're not seeing that. Sellers are so concerned about being able to buy their other property, they're reluctant to come to the market. So as long as we have sellers continuing to stay reluctant to come to the market, as long as we still have very accommodative policy from the Fed, as long as bond yields kind of level at where they're at, meaning 30-year mortgage rates are going to level out where they're at, we're going to continue to see this environment of upward appreciating values. So there you go. That's April's market update. It was a little deep. I apologize for that. We'll continue this again next month. If you have any questions, don't be afraid to hit me up at Rarebird Real Estate or at my handle at Rarebird Mike. We'll go from there. Have a great week and happy investing all. Adios.